What is going on, everybody? Today we will be taking a look at two of my favourite topics of discussion, saving and investing. Now, these two things are vitally important and they form two of the four pillars of financial education. And the question that I'll be taking a look at today is how much should you save versus how much should you invest? Now, although saving and investing arguably go hand in hand, they are still two very distinct things, and it is very wise to have an element of both in your approach to building wealth. So, what do I mean by this? Well, say you had all your money in savings. The only way to grow your wealth would be to save more money. Not exactly the most efficient thing to do, as you would have to save a colossal amount in order to retire comfortably. Whereas, if you had invested some of that money, you would then have the power of compound interest on your side, and so you wouldn't have to save anywhere near as much, and yet still be able to retire comfortably. On the other hand, having all of your money in investments isn't the wisest approach either. Say, for example, the country went into a recession and you ran into some tough times and you need some cash. Well, yes, technically you could just liquidate some of your investments and use those as cash. However, that wouldn't be a great idea. You would likely be selling those investments at exactly the wrong time. In fact, any time your hand is forced, any time you are forced to sell an investment, that is not good. You always want to be in control of your money decisions. Market crashes and recessions are generally where the most money is made, and so selling your stocks or your shares at the bottom of a crash just because you need some cash, well, that's not ideal. It would be a huge setback and would significantly reduce your net worth. Thus, this is why it's important to find a balance between how much you save and how much you invest. So what is the right balance? Well, as with many things in life, it is of course relative, but I have gone ahead and put it into three general categories for you. The first category that you may fall into is the dependent. These are your teenagers and students who are still pretty dependent on their family. It's the people who are in the stage just before they leave home or university, and so they still have the safety net of their family. Because of this and their age, this category can afford to take the most risk. If things go downhill, it's not a train smash because they are still young and they have this safety net. And if things go really well, in that case they will be far ahead of the pack, or at least far ahead of most people their age. As such, these people can afford to put 90% of their money into investments and only 10% in savings. If things go south for you in this stage, it is really not the end of the world, and the consequences aren't that bad. In fact, considering that most Americans at this stage in life have a negative net worth, having your net worth reduced to almost zero is hardly a setback at all. As sad as it sounds, you're still ahead of most Americans in that stage. Okay, so the second category that you might fall into is the independent. These are your single adults. Now, as a fully fledged adult, you are no longer dependent on your family, and so you need to have your own back, as it were. As such, it probably wouldn't be wise for you to put 90% of your money into investments and have only 10% in savings. Because if something goes wrong, if, say, for example, you lose your job, well, that 10% in savings might not last that long, considering you now have to pay your bills, something you didn't have to do when you were in the dependent stage. If that happens, you would then need to sell some of your investments in order to pay your bills. And as we already established, being forced to sell your investments at any time is never a good thing. Considering this then, a better approach would be the following. The first thing you want to do is build up a 6-month emergency fund. The way you can do this is by calculating your monthly expenses and timesing that by 6. That is how much money you should aim to have in savings. So the independent doesn't have to save and invest a specific ratio of their money, so long as they have at least 6 months worth of expenses saved up in case of an emergency. After the independent has their emergency fund saved up, they can then go and put the rest of their excess income, after they've paid their expenses, into investments. Now, there is still an element of risk here, and so the independent shouldn't plan on selling these investments for around 20 years. But considering the fact that they have their 6-month emergency funds to fall back on in the case of something going wrong, this would be a calculated risk with the hopes of a long-term reward. Now, lastly, we have the dependee. Whether or not that is actually a word, I'm not sure, but I use it to describe someone on whom other people are dependent. So this would be your married adult, on whom their spouse or family is dependent. Now, in this category, it would be wise to increase your savings slightly, as you now have other people to consider. You see, when you were a single adult, when you were in the independent category, it was okay if you wanted to take a little bit more risk and then slum it if things didn't go very well. However, now that you have these other people depending on you, you can't exactly expect them to do the same. In this case then, a 12-month emergency fund, enough money saved to cover an entire year of household expenses, is a wise decision. Whilst possibly erring on overcaution, these people, the dependees, have their loved ones on the line, and so being overcautious is understandable. After they then have their 12-month emergency fund saved up, they can then afford to invest the rest of their spare income. Now personally, I also like to put aside additional savings, different from my emergency fund, and this is for opportunities, financial opportunities that may at some point present themselves. For example, if there is a market crash and everyone is panicking and getting out of the market, well, that's a brilliant time to get into the market. Stocks are essentially going on sale. However, I would not use my emergency fund for this. This is why I put aside additional savings. Because if I use my emergency fund to buy into the market and something happens, like I lose my job and the market takes a bit longer to recover than I anticipated, well, then I could find myself in a pretty tricky situation and possibly be forced to sell my investments, which is not what I want to do. Therefore, a good rule of thumb to follow, depending on which category you are in, is to set aside a 6 to 12-month emergency fund, after which you can then take the rest of your spare money and split it into 10% additional savings and 90% investments. This way, you are covering your back with your emergency fund in case of a problem. You are also investing the majority of your spare income, and you're keeping a little bit of additional savings on the side in case a financial opportunity presents itself, at which point you may then take advantage of it. So that is my breakdown of how much money you should save versus how much you should invest. If you enjoyed this video and you would like to see more content on making money, saving, investing and building wealth, then do go ahead and subscribe. Also click that little notification bell so you never miss a video. I upload videos every Monday and Friday, and I really look forward to seeing you in the next one.